90% of people who try to buy a business never actually do. They spend years searching for the right business, and some even make offers, but still walk away empty-handed. So in this video, I'll show you the 4 key metrics you can use to quickly decide whether a business is worth buying or not. Here's the thing, I see people get this wrong all the time. They start valuing a business before they've checked whether it even deserves a valuation. One student arranged a meeting with a business owner involving a 3.5-hour drive. Beforehand, they'd already discussed seller finance and admitted they'd become emotionally attached. The business was turning over under £100,000 with profits of just £24,000. This is buying a job, not an asset. That's why these metrics matter. If you don't rule out the wrong businesses early on, everything that follows is wasted time and effort. When I bought my £1 million business, I started by checking these 4 key metrics to decide whether it was worth taking any further. When you follow a proven process, you quickly discover whether a business is worth your time and effort. You're no longer trying to make a deal work, you're simply deciding whether to move it to the next stage. And that changes how you look at every deal. These 4 key metrics you should look at before anything else. And here's the thing, if a business fails any one of them, don't go any further. Metric number 1, profit and loss checks. From the profit and loss, you can quickly answer 4 important questions. Question number 1, does the business have sales of at least £1 million? When a business has sales of at least £1 million, it proves the market exists at scale. But here's the truth. Getting a business to sales of £1 million usually takes years, especially considering only around 4 to 5% of UK businesses ever reach £1 million in turnover. And here's the point that most people miss. Buying a £1 million business and growing it to £2 million is far easier than starting from scratch and trying to reach £1 million. To check whether a business has £1 million or more in sales, simply ask the owner for the last 3 years of accounts. Then look at the most recent accounts and go to the profit and loss and check the turnover figure to see if it clears this hurdle. If it does, move on to the next question. Question 2. Does the business have profits of at least £100,000? Here's the thing, if a business isn't making at least £100,000 in profit, you have to ask a simple question. What's the point of giving up a decent salary and taking on the risk of owning a business? After all, never underestimate the added responsibility, pressure, and challenges you'll face with staff and customers when you own a business. The reward needs to be worth it and a step up financially. To check this, go to the profit and loss and look at the operating profit figure. If the operating profit is more than £100,000, this test is passed. But here's the thing, this figure is usually after the owner's salary, which means the true profit available to you is often higher than what's shown on the profit and loss. If this test is passed, move on to the next question. Question 3. Are sales and profits trending up? When you review a business, you need to review the trend in sales and profits. This is why you need the last 3 years of accounts, which is because each set includes a comparative year. This will give you visibility over 4 years of trading. You're looking at trends in both sales and profit, where obviously an upward trend is ideal. Flat sales or profits can be acceptable, but be cautious. As Tony Robbins says, if you're not growing, you're dying. Having said that, this may represent an opportunity to grow the business. Consistent decline will need an explanation and might be a red flag. If the business is flat or declining, but the market is growing, This points to a problem in the business. If the market is stable and the business is declining, that's still a concern. And if the market itself is declining, you probably need to avoid this sector altogether. To check trends, line up the last 3 years of profit and loss accounts and compare year-on-year sales and profits. Tools like AcquiCalc make this quicker, which is a tool I use to assess, value and finance business deals. If you are happy with the trends, move on to the next question. Question 4. Does the business have a robust gross profit margin? This metric isn't about being exact, it's about risk. As a general guide, I like to see gross profit margins around 40% or higher, because that's where businesses tend to be far more robust and forgiving. Here's the reality. When margins are low, even small changes in sales, costs or overheads can wipe out profits entirely. Margins around 40% give you breathing room to absorb fluctuations and still make money. Margins between 30 and 40% still work, but they sit in a higher risk zone. Many solid businesses operate here, but they're less forgiving. So you need to see how the business has held up historically when costs rose, sales dipped, or competition increased. Margins below 30% move you into a higher risk category. They still work, but usually only in simple, low overhead, asset-led or volume-driven businesses, and they require much closer scrutiny. To calculate the gross profit margin, divide gross profit by turnover and multiply by 100, or use a tool like AcquiCalc to calculate this instantly. If margins are well below 30%, I'd usually move on. If they're between 30 and 40%, it doesn't rule out the deal, but it becomes something you need to test carefully during the due diligence stage. And if they're 40% or more, you can be far more confident and move on to the next metric. Metric number 2. Does the business have a 10+ year trading history? When it comes to buying a business, time is your friend. The longer a trading history, the better. A business that's been trading for over 10 years has survived different markets, economic cycles, and problems along the way. Here's the truth. Nearly 7 out of 10 businesses don't survive past 10 years. So using this metric alone dramatically improves your odds of success. To check this, search the company on Companies House and look at the incorporation date to see how long it's been trading. If this is more than 10 years ago, move on to the next metric. Metric 3. Does the business have more than 1 or 2 employees? If the business is basically the owner plus 1 or 2 other people, be careful, because that usually means the business is likely owner dependent. They likely hold the key customer relationships, which means when the owner leaves, the customers may leave too. Here's the hidden truth. If a business is heavily reliant on the current owner, once you buy it, it will be heavily reliant on you too. This metric isn't foolproof, as some businesses with several employees can still be heavily owner dependent. But if a business passes this initial test, you can dig deeper in the owner meeting if the business passes all of these metrics. But for now, you want to see people in place suggesting it can operate beyond the owner. So you can easily check this using the accounts of the business by turning to the notes and looking for the note section labeled employees. That note tells you how many people work in the business and whether it passes this metric. If a business has fewer than 5 employees, there's a strong chance you're buying a job. Above that, it can work, but I generally look for 10 employees or more, because that's where a business is far more likely to operate without the owner. If it meets that threshold, you can move on to the next metric. If it's below 10, that doesn't rule it out, but it becomes something you need to test carefully in the face-to-face meeting with the owner. Metric 4. What do customers say about the business? Customer reviews can tell you a lot about a business. Firstly, check to see if the reviews are genuinely positive. If not, this may indicate a problem to avoid or a potential opportunity for improvement. But then look at the sentiment behind those reviews by carefully reading what people say. For example, do customers repeatedly praise the owner by name? Or do they talk about the business, the service, and mention different members of staff? If the reviews repeatedly mention the owner, that's a strong signal the business is owner dependent. But if reviews talk about the brand and multiple team members, that's a much better sign that the business is run by the employees. The best way to check this is to look at Google reviews, Trustpilot reviews, or any relevant industry platforms like Checkatrade or TripAdvisor, and read the comments, but pay particular attention to who the praise is aimed at. So now you know how to filter out the bad businesses. The next step is finding the good ones. The best way to do that is to find off-market deals, because around 80% of profitable businesses are sold off-market. Watch this next video and I'll show you exactly where to find great businesses to buy.